Good morning, and thank you very much for joining us today for another webinar in our Rated by Kepler series. I'm Joe Litchow of Kepler Trust Intelligence, and today we'll be turning our attention to the Asia Pacific equity income space. And in just a moment, we'll be hearing from Isaac Tong, Senior Investment Director at Aberdeen and Lead Manager of the Aberdeen Asian Income Trust. Before I hand over, just a very quick word on what to expect today. Isaac is going to be speaking for 20 to 30 minutes or so, sharing an update on the trust. And after that, we're going to be moving into a live Q&A session. And we'll aim to cover as many of the questions that you post towards the end. So if you do have any burning questions now, or even throughout the presentation, whether it's on the trust itself or on the broader market environment, just drop them into the Q&A box on the bottom right hand of your screen and we'll get to those at the end. So with all that said, Isaac, it's an absolute pleasure to have you today. Over to you.
Hi, thanks a lot. My name's Isaac Tong, and I am one of the portfolio managers on the Aberdeen Asian Income Fund. So today, by no surprise, I'm here to talk a little bit more about the investment trust we run and maybe go into the slides. Firstly, why should you even consider this trust? The trust seeks to give you access to Asia's strong growth story in a very balanced way. In doing so, we identify and back quality dividend franchises over long periods of time. Results have been encouraging so far. Our one-year share price total return was up 51% as of April, and we did this while also delivering to you a 6.8% dividend yield, which is quite healthy in our view. In terms of performance, the trust has delivered outperformance compared to the benchmark, which is the MSCI Asia Pacific ex-Japan benchmark, over 1, 3, and 5-year time periods. We have also delivered our 17th consecutive year of annual dividend increases, closing in on that 20-year dividend hero status. The trust also comes to you cheap. Our fees are market leading at just about below 75 basis points, and we also trade at an 8% discount to net asset value, NAV, which is a level that is much wider than the sector average. We have a very active board that monitors this discount and really aims to narrow the discount through various means, including high dividend payments, as well as timely share buybacks. So rest assured, the board is really laser focused on this number as well. So moving on to why Asia. Well, in summary, Asia is fast becoming one of the world's leading investment destinations. Just last year, in 2025, the region outperformed the S&P 500 by 12%. This was a first since 2017. So Asia's finally back. It's been a bit of a wait, but here we are. I think to extend that lead, year to date in 2026, Asia has actually been leading the S&P 500 again by 18 percentage points. So we've extended this lead this year. Global investors are quickly recalling the fact that Asia is the heart of global growth and really drives over 50% of incremental GDP growth. This growth has also led to strong total shareholder returns over long periods of time. If you look back 20 years, you'll see the fact that strong GDP growth has resulted in strong market performance. So we have that translation mechanism that is working well and fine and continues to work today. What's interesting and even less talked about is the fact that half of total returns in Asia historically have come from dividends. You see, in Asia, growth comes with a wider range of outcomes. Things just do not move in a straight line here. So it is very prudent for us to take a balanced approach to investing. Fortunately, Asian companies have been focused on improving their cash flow generation, enabling investors like you and I to enjoy both growth and income at the same time. So moving on to that slide that we have on the page. So now that we know why Asia, perhaps why income. And I think it's quite instructive for us to talk a bit about our investment approach and how we want to generate a return for you. So first and foremost, once again, we aim to harness Asia's growth potential in a very balanced way. In doing so, we narrow in that range of outcomes that I spoke about previously by balancing growth and income in the portfolio while staying invested in high quality companies. All our holdings are dividend franchises. We identify such companies in a methodical way. The first thing we look out for will be for quality companies, quality businesses with high sustainable returns on equity. The second thing we look for is reliable free cash flow generation. And not last but certainly not least is our third point, which we really want to identify companies and management that have sound dividend policy. You see, in Asia, we view sound capital allocation as a very tangible form of corporate governance. This is especially important when investing in state-owned enterprises in Asia. Well, after identifying these dividend franchises, we classify them in three ways. And on the next slide, you'll see our three classifications. We call them the three C's. So there are three categories of companies. The first being compounders, the second being consistent companies, and the third being cyclicals. So this bears a little bit more explaining. Compounders are our long-term holdings. Companies here are likely to generate shareholder value as they grow and are more resilient to business cycles. Consistent companies are our defensives. They deliver high and reliable income while growing earnings about in line with inflation. So they give us a higher amount of dividend yield, but they grow comparatively slower than compounders. Cyclicals are our tactical holdings. They give the trust its value attributes, while we also expect a cyclical turnaround in some of these businesses tactically. So over here, our investment horizon in cyclicals are shorter, and we are more valuation sensitive here. Of course, we like to hold more compounding companies or compounders, but we are also mindful of owning them at the right valuation. So not the entire portfolio is positioned in compounders, but we do have substantial positioning there. And next, on the next slide, after identifying our three categories of companies, what we want to do is to invest across a spectrum of businesses. And this is really to achieve the right mix of growth and income for the trust. We are agnostic on the corporate life cycle, but instead we focus on total shareholder returns. So let me just give you two opposite examples here. The first being Tencent and the second being DBS Bank, which are on the left and on the right of this chart. So Tencent is a leading internet platform in China. If you go to China, it's pretty much impossible to live without Tencent's app, WeChat. And we think that Tencent is a high quality growth company that should grow earnings at about 11 or 12% every year for the next 5 years. However, Tencent's cash dividend yield is about 1.5% today. So it is a low yielder, but high grower. And on the flip side, you have DBS Bank, which is the leading retail bank in Singapore. And by virtue of the fact that it's based in Singapore, its growth is automatically lower, right? So we expect DBS Bank to probably grow earnings in the vicinity of 3 to 4% over the long run. However, if you look at its dividend yield, its cash dividend yield is close to 6%. So if you add these two factors up, and assuming that you purchase both Tencent and DBS at fair valuations, then the total shareholder returns are actually about the same. So this is a good example of how we can own both Tencent and DBS Bank with different growth profiles and different yield profiles, but both quality businesses at the same time in the trust, and they serve different functions, but they deliver a similar result in terms of total shareholder returns. So this is really how we invest your capital and how we put the portfolio together. So moving on to the next slide, why us? Well, here's the story of Aberdeen. Aberdeen is really the home of quality investing in Asia. We are Asian specialists since the early 1990s, where we first started up our first office in Singapore and our whole Asian franchise. And currently today, we have 35 investors on the ground here in Asia. Additionally, both the trust portfolio managers, which includes myself and Eric Chan, are both based in Singapore. So we all live and breathe Asia on a daily basis together as one team. Another thing to note is that quality is our North Star at Aberdeen, and it really guides our entire investment approach. This spans from how we conduct our 1,000 company meetings a year to how we construct portfolios and how we manage risk. Now let's move on to why now on the next slide. Well, today is really a compelling time for Asian investments. The world is once again coming to Asia for growth, while we are also trading at large discounts to global peers. After a valuation-driven rally in 2025, this year promises to be one of earnings growth. We expect earnings to shine through in 2026 to justify current valuations. As they say, a company will grow into its valuations. So we think that this year is that particular year. Right, despite doing well for over the past 2 years, Asia still trades at incredible discounts to global peers, particularly a 35% discount to that of the United States. Last but not least, policy in Asia has turned favorable in places like South Korea and China. Companies here are focusing on free cash flow generation and striking the right shareholder return profile with respect to the growth opportunity in front of them. Now we move on to performance on the next slide. So despite strong market performance last year and style headwinds, our more conservatively run strategy still managed to keep up with the benchmark. As of end of March this year, we posted positive relative performance over both 1, 3, and 5-year time periods. Our 1-year performance in particular was helped by our approach to reduce factor risk in the portfolio, chiefly by reducing our country active positions and investing in both growth and income. Over the last year, on the next slide, you could see that stock selection really drove a fair proportion of total returns. You could see that on the top right-hand corner. And this is really an outcome that we are striving towards, so a very encouraging result. On a country basis, stock selection in China and Taiwan were our top contributors, while our underweight position in India also helped as the country underperformed. However, at the bottom, you'll see that Korea remained the negative detractor, both in terms of allocation as well as stock selection. And I think given the breadth of income opportunities in South Korea, we really have our work cut out for us here, and we strive to generate better stock selection in Korea, hopefully this year. And on the next slide, when it comes to single stocks, more importantly, you could see that performance last year was driven mainly by our semiconductor companies, while our underweight positions in certain Chinese consumer names also helped performance. But on the flip side, and on the chart on the right, you'll see that our largest detractor was SK Hynix, where we are underweight, as the stock more than doubled. So what we have done here is to really control that underweight position in favor of an overweight position in its competitor in memory chips, Samsung Electronics. This hasn't worked out in our favor yet, but we are keeping the faith and keeping the position. Meanwhile, if you look at our other detractors last year, they included mainly IT services companies in India, as AI threatens to disrupt their business models. And then you also have banks in India and Indonesia as detractors on the back of weak macroeconomics. So let's move on to positioning on the next slide. I think the first thing you should know about our country positioning on this particular slide is that it is quite benign. So a 1 to 2% active weight at a country level is quite light in our view, and this is really intentional. What we have been trying to do over the last year is to really minimize factor risks, such as country risks, and maximize stock selection risks. Remember, we are bottom-up investors, and we want the bottom-up stock selection to drive the performance outcomes going forward. To this extent, we have brought stock selection risk to about 80% of the portfolio, and we are quite comfortable at this level. Where we tend to be underweight, though, on a country perspective, is in India, at the bottom left-hand corner. Well, in India, income is just harder to find. India does have a lot going for it in terms of quality growth companies, but that just doesn't suit what we are trying to do, and that is to achieve that balance of income and growth in Asia. Hence, it just doesn't suit what we are trying to do, and we remain underweight. India has an average yield of about 1.5% compared to 2.3% that the index is delivering in terms of dividend yield right now. So you could see the challenge in India. Meanwhile, on the right-hand side, you'll see our sector weights. So on sectors, real estate really does stand out as a key overweight. However, we'd like to emphasize that this is not your traditional real estate developer, but instead they comprise of REITs, real estate investment trusts, which are our consistent companies delivering high yield in a very defensive, consistent manner. And they also include mall operators, which are actually more levered to consumption, right? They are more consumer plays in various countries such as China. The other overweight would be in IT, which is largely our semiconductor stocks. Semiconductors are a key area where we get a favorable mix of business quality and income generation, and they tend to be a key feature in our trust. Our underweights, meanwhile, are mainly to healthcare and industrials. Both are areas where income is once again harder to find, although we've been recently adding to Chinese industrial companies such as CATL, which is a leading battery maker globally. Healthcare has lagged the broader market, and this could actually throw up future opportunities as dividend yields improve. Now, on the next slide, when looking at our top and bottom active positions, I think the first point to note on the left-hand chart is how diverse these positions are. I think in Asia, the region really provides a broad universe for income investing, and there's no shortage of opportunities. So let's go through a few examples here. The first one on the top left-hand side would be Samsung Electronics. This is one of the top memory chip makers globally. There are 3 leading memory chip makers today that provide the memory chips that power data centers especially. Right? One is Samsung Electronics, the other one is SK Hynix, and then you have Micron in the US. So a very consolidated subsector. So and Samsung Electronics is also trading at quite an attractive valuation, and they're poised to pay out a special dividend at the start of next year. So hence we are quite overweight this name. The next one would be Rio Tinto, which is a globally diversified miner. It's an Australian company, but it really is a leading global miner with very low cost of production. So this is another area we're positive on. And then the third company would be HDFC Bank, which is the leading high quality retail bank in India. And then if you take another step down, you have China Resources MixC, which is a mall owner. It actually doesn't own malls, it runs malls for its parent, China Resources Land. We like its capital light business, and it's really outperforming the industry in terms of same-store retail sales. Last but not least, I think the fifth one is one you probably haven't heard of. It's a recent addition to the trust. It's called Grand Process Technology, and it's involved in manufacturing, in providing semiconductor equipment to companies such as TSMC. So those are some of the companies that we hold in the trust, one of the top overweights. And if you go further down the list of the top 10 active positions, you'll see a very diversified group of companies across different sectors, as well as present in different countries throughout Asia. So once again, emphasizing that broad reach that Asia has in terms of finding those quality dividend franchises that we want to back over the long term. Right. So let me just summarize here with 3 key points. We have gone through a lot today, but if you were to take home 3 points, here they are. The first one is that Asia is an attractive investment destination, but we do need to harness its potential in a very balanced way. And that to us is a mix of quality and income. The second point is that Asia is extremely undervalued and underestimated. So the right time is indeed now. And the third point is that our strategy has delivered performance over long periods of time, and the discount that we are trading at is very compelling in our view. So with that, I'll hand the time back over. Thank you very much, and we'll be very happy to take questions.
Thank you, Isaac. No, I think that was a really, really good insight to the trust and how you're positioned at the moment. Naturally, we've got a few questions that have come through, split between some on the trust and some on broader market outlook bits. But I think let's knock out a couple of the trust specific questions. Given the volatility this year, particularly year to date, how much trimming or top slicing have you and the team been doing? And kind of a leading on question from that, are you happy with the current gearing level given the opportunity set?
Yeah, the first question first, how active have we been? I think we have been less active than last year. So last year, when I came on board to the trust, what Eric and I have been doing is to really control the factor risk that we mentioned. So that included pulling in our active weights, especially on the country level, and that really incurred quite a bit of turnover. So I think a lot of that is behind us right now. We are very happy with how the portfolio looks from a country level. And if you look at our where we have covered our underweights, that's mostly in China. And to this extent, we've added more names in China. So last year, you'll see that at the start of last year, the number of individual stock holdings we had was about 50, and today that stands at above 60, right? So we have found new opportunities throughout Asia, predominantly in China, and we have closed that factor risk as a result. So I think we're quite happy here. We obviously want to stay active in today's volatile market. So we have taken profit and added new positions like Grand Process in Taiwan that I spoke about. But I think that has been, quite minor action in terms of portfolio turnover. So I think the turnover has actually eased to a more sustainable level, right? And then on your second question on gearing, we have taken our gearing up slightly to about 5 to 6%. Gearing had actually fallen to about 3 to 4% recently because Asia has done quite well and the net asset value has climbed while we didn't draw down further on debt levels. But we have taken that up ever so slightly. I think on market pullbacks, we might add a bit of gearing to the trust, but I don't think we'll do it excessively, right? Because gearing does help boost returns, but in periods of drawdowns, it also accelerates losses. So we want to be prudent here. I want to strike that right balance.
Brilliant. And I guess in terms of opportunities then across the region, we hear a lot about some of the larger, more dominant names in the region, but you and the team's view on perhaps the smaller companies across the region, the index might not capture as well. And given that you're on the ground, spread quite across the region, does that give you a bit of an edge in identifying those small and mid-cap stocks?
The short answer is yes, and we actively do that. So at Aberdeen, one of our core products are small cap funds, right? In fact, I'll do some marketing for Gabriel. His Asian focus fund, which is also an investment trust, is extremely successful. So we also lean on that expertise. And Eric Chan, who is a co-portfolio manager on the income trust, also sits on that portfolio construction group. So we really want to lean on Aberdeen's expertise in small medium cap companies, right? And if you look at the amount of small, medium-sized companies that we hold, they are over-indexed, right? So we are overweight that segment if you want to put it that way. We're over-indexed on small, medium-sized companies, and I think you could see that in our top 10 holdings. Grand Process is a small cap, right? And it's also owned in some of our small cap funds. Sino-American Silicon, right below Grand Process there on slide 10, is also a small, medium size company that produces wafers to global semiconductor companies.
Brilliant. You did touch on it slightly in your presentation in terms of the opportunities in Korea, but slightly deviating further east, and we're looking at Japan. I know obviously the benchmark is Japan, but you do have the flexibility at times to invest off benchmark. And in 2024, there's a small allocation to Japan, but there isn't at the moment. Can you talk us through your kind of view of the opportunity set there, and perhaps why the trust has no exposure at the moment?
Yeah, I think for Japan, there are a few things to think about, right? Firstly, what's the opportunity there? We do have a team in Japan. We have a successful Japanese franchise as well, and a few Japan funds, including small caps. So we do want to tap onto that expertise in house. But I think at the current juncture, we see quite a lot of opportunities in Asia ex Japan, Asia Pacific ex Japan rather. So we want to continue to invest there, because to us, this is, like you mentioned, an off benchmark position. So conviction has to be extremely high that they can deliver returns over and above the current geographies that are in our benchmark, right? And then the second thing to think about is the Japanese yen, the currency and how that's going to move. So right now we don't have a strong conviction, at least relative to the Asian currencies. So I think we just want to sit on our hands for the time being and wait for better opportunities to surface, which I'm sure our Japanese team will inform us of.
And Isaac, moving slightly to the dividend policy again. I know you spoke about it at the beginning of the presentation, but it was announced, the enhanced dividend policy anyway was announced kind of at the start of 2025. So that's been in place for a good year now. And it'd be good to just delve a little bit deeper into that and kind of hear your thoughts on how it's working in practice. Have there been any slight tweaks to the process, for the companies that you're willing to own, and perhaps get your view on dividend cover over the coming years and how you think that's evolving?
Yeah, so the first point was how we enhance dividend, and I think this topic bears elaboration, right? So what we do for the trust is we set aside about 4% of our net asset value to enhance dividend. So what we do here is we take tactical positions in companies that we already hold just before they go ex-dividend, and we harvest the dividend, right? And then after we harvest the dividend on the ex date, we exit the stock quite quickly, right? So these are done on the over 60 stocks that we hold, right? We choose to do this in a conservative way because we understand the 60 names we cover, and we also know when their ex-dividend dates come due. We're also aware of special dividends that these companies will offer from time to time. So I think we want to make sure we know what we're doing, right? And why 4% of NAV? Well, we think that this proportion of dividend harvesting is enough to boost yield by about 2.5%, right? So the natural yield of all the dividend franchises that we hold. So do note that all the stocks that we hold are income generating, right? So these stocks generate income of about, with dividend yield of about high 3%. So call it 3.7, 3.8%. So we add 2+% on top of that, and that really gets us quite close to our 6.25% dividend commitment, right? Which was the enhanced policy that was started last year, right? So we have maintained that policy, and we have delivered on that policy. So we are 6.25% dividend yield, and then you add on that discount that we're trading at share price wise, and you get closer to 7 actually. So that's quite an attractive yield to shareholders, and the board of directors obviously has full discretion over that. But the board does believe that it's an attractive yield when it comes to comparing that to fixed income as well as term deposits in the UK. And it really does have that nice balance between that kind of yield and capital gains that we have also achieved. Like I mentioned, we have, in terms of performance, we have kept up with the benchmark, right? We've actually outperformed the benchmark. So shareholders essentially at this level can have their cake and eat it in terms of current income, as well as riding on that capital gain story, which Asia seeks to deliver at the same time.
And just on the dividend cover as well, I know I threw a lot at you in that question. Your thoughts on how that looks? I guess, is it a differentiator versus others in the sector in terms of how you're covering that enhanced policy, or how do you see that developing?
Yeah,
Because we've spoken about the value up in Korea, the dividend culture is improving across the region. It would be good to kind of get your views on how you see that evolving.
Yeah, the dividends are more or less fully covered by income, right? So there's income from the natural yield that of our holdings, and then as well as the that dividend enhancement strategy that we deploy as well. So it is fully covered, and I think that does differentiate us from some of our peers. We are a pure income fund, right? Every company we hold delivers income to unit holders, right? And then on top of that, we enhance the dividend with this harvesting strategy, right? Which is really a small portion of net asset value, right? Because we could enhance it even more by doing enhancement strategy on a higher proportion of net asset value, but in doing so, we would actually it might not be so good from a capital returns perspective, right? Capital appreciation perspective. So we want to really strike that balance, and we think we have achieved that balance.
And we touched on a few of the differentiating factors of Aberdeen Asia Income versus the sector, but an interesting question on why investors would go for a regional fund such as this compared to a global fund, which, let's just say, we have comparable resources and similar performance track records, but obviously the opportunity set for a global fund is much wider, including access to the Asian region. What's the kind of pull for the regional fund over a global fund?
Yeah, I think if you go back a couple of slides to that one on valuations, that one, right? Slide 7. Firstly, if you look at a global fund, if you look at the amount of if you look at the benchmark of an MSCI World, the US will feature a lot in that benchmark, right? So I don't have the exact number, but it's something like 60+%, right? So vast majority of a global fund would be in the US, right? And if you look at how the US trades compared to Asia, you'll see on the PE valuation metric on the slide on the left, you'll see that there's this big gap, and this gap is about the widest it has ever been for the last 2 decades, right? So on a PE basis, Asia looks quite cheap, right? We're trading at a 35% discount to the US. So I think that's something to bear in mind. But if you look at things like return on equity, which is a key quality metric that we look at, and that's on the right-hand slide, you'll see that Asia is still behind the US. So that valuation, some of that valuation gap is justified, but this is a slightly older chart. But if you look today, you'll see that ROE gap is closing, right? Chiefly because of some of the semiconductor companies in Asia, which is helping lift ROEs of Asia from a trough. And we think that that's really going to help narrow that PE valuation gap. And that's one of the reasons why Asia does stand out. And probably that's one of the reasons why Asia has outperformed the US over the last year and a half, right? And it's the first time we have outperformed since 2017. So I think there's still a lot of juice left in the tank where it comes to potential returns. And that's probably a reason why investors should really focus on Asia as a destination.
Fantastic. And obviously one of the biggest economies in the region is China. I know Taiwan and Korea have overtaken China in terms of size in the MSCI EM index, but obviously an incredibly important economy globally. It rallied hard in 25. That's well documented. That's been spoken about, in quite a lot of detail, but obviously has since fallen off. Are we seeing that rally as a kind of short-lived rally with some of the structural headwinds outweighing opportunity still, or do you and the team view it approaching a point where it becomes too cheap to ignore again, and the risk of it rallying and people not having that exposure like they did in 2025?
Yeah, so like you rightly mentioned, China performed quite well in 2025, and this year has taken a breather, right?
Mm.
Um, I think China firstly in China, it's hard to view China as one country like we view the rest of the countries in Asia. You know, China and probably India as well are very deep markets, very broad and deep markets, right? It's kind of like the US almost, where there are so many different opportunities within the same country, right? So I think in China, despite negative headlines, so for example, China just released some consumption numbers and they were not too good, right? Retail sales were to actually turn negative in May. You have the property sector, which is still um, easing, which is still sliding in terms of property prices, right? So we haven't seen the bottom yet. Auto sales are quite poor. But if you look past all these numbers, you have companies within those segments, consumer companies and industrial companies that are actually going to emerge as champions. They're going to gain a lot of market share, not just in China, but globally as well. So China is truly one of these places where global champions are emerging, right? Obviously, it's harder for China to export because of certain restrictions and tariffs in place, especially in the US. But some of these products that are coming out of China are so reliable and produced with such efficiency that despite the tariffs, they are actually being exported in good quantity, right? So I mentioned we have taken positions in CATL, the battery maker, and it's one of these examples where it's truly a global champion with 40% global market share and climbing, right? So you're seeing all these type of companies in China, despite the negative headlines, which should actually present quite good opportunities for us, especially in the quality income space, where earnings are actually growing, but valuations are, share prices are coming down. So from an income perspective, they're actually getting more interesting because dividend yield is going up, right? And you're getting the same level of quality from the business.
And Isaac, you touched there briefly on the kind of trade tensions and tariff risks, and there's been quite a lot of dialogue around the impact of trade tariffs, and obviously this year we've seen some geopolitical tensions, particularly the conflict in the Middle East. And I just wonder how you and the team are viewing those risks of the region, but perhaps are there any other risks that are less talked about that investors not so immersed in the region are unaware of, and how you as active managers feature that in your kind of discussions around portfolio construction?
Yeah, I think given the diversity of the region, right? So it's not like the US where it's just one country with one political system. In Asia, we have so many different countries with different political systems and election cycles as well. But I think that also offers a lot of diversification benefits, right? Because a lot of these political issues in each country are not quite correlated with each other, right? So we can tap on different opportunity sets at the same time. Where it comes to the election cycle, I think currently we are pretty much in the clear for a lot of Asian countries. They just had elections not too long ago. So the cycles tend to be 4 to 5 years. So I think we actually have quite good runway where it comes to politics. When it comes to geopolitics, though, obviously, China is always in the crosshairs of the US and the EU to some extent, right? As they all want to remain competitive. But I think in today's world, everybody is trying to carve out a piece of the world for themselves, right? So you have every country, I think, has to decide where they want to be self-sufficient on and where they want to remain competitive on, right? And even the US is doing this with different subsidy programs such as the CHIPS Act, right? Which is their own, and then built in the US, right? Made in the USA. They also have their own different agendas, right? So I think you're going to see more countries start to do this, but this is where diversification helps. And I think in Asia, because of the many geographies we can deploy capital in, we do have that diversification benefit, right? And I think China in particular, we want to be aware that a lot of global champions are emerging, but at the same time, geopolitics are the tensions are increasing as well. So I think you want to be a bit below the radar in terms of the kind of products you export, products that are not too sensitive. So if you're exporting things like white goods, which are refrigerators, air conditioners, I think they're not very sensitive geopolitically, right? But if you're exporting cars, then perhaps from a jobs perspective, because cars create a lot of jobs in the EU as well as the US, then maybe you want to be a bit more sensitive here, right? So it does depend on the sector that you're looking at as well. But we think the opportunity set in Asia is so broad that we can do it in a good risk adjusted manner.
Thanks, Isaac. And just I think time for one more to squeeze in, and I think it would be interesting to hear your thoughts on the kind of AI semiconductor play. You spoke about an overweight in Taiwan, the trust hold, and obviously the underweight in South Korea, but how you're managing that position. But outside of those two kind of dominant regions within the AI theme, where else are you seeing value, and how are you positioning the trust in that frame? And also, given AI is dominating returns, is there a worry within the team about concentration, and how are you kind of approaching and managing that?
Yeah, the trillion-dollar question, multi-trillion-dollar question. I think we are by and large positive on AI and semiconductors, right? So I know we are underweight Korea and Taiwan, but if you look at it at semiconductors as a sector, which is increasing, which has it's almost 40% of the benchmark, we are overweight semiconductors, right? But we are not overweight to a very large extent, right? And we have been actually controlling that overweight position because, as you know, when you're overweight a sector and the sector outperforms, which it has, then your overweight gets larger, right? So what we have found ourselves doing is actually we have to trim some of these positions and deploy elsewhere. Okay, so we have been actively doing that this year just to not let that overweight get too large, because, like you say, concentration in the index is rising. Investor positioning is obviously heavy in the semiconductor sector, and at the same time, earnings are very, very strong, right? If you look at earnings in Asia this year, a lot of the upgrades have been driven by the semiconductor sector, right? So it's almost like one sector is lifting, the whole market in terms of the earnings picture, right? And then when we look at that gap, that valuation gap we are trading at versus the US, well, a lot of that gap will be closed by semiconductor companies as well, because the average semiconductor company here is trading at a cheaper multiple than that of the US, right? So, we have a lot of different things going for us here. And because, the range of outcomes have definitely widened, especially as valuations have increased, right? If you look at the average AI winner in semiconductors, they trade at a dividend yield of less than 2%, right? So, you compare that to the average yield of about 2.3% on the index, and our fund is yielding, high threes on a natural sort of basis without the enhancement. You'll see that AI, positions in AI semiconductors actually detract from our average yield. So what we need here, once again, we're trying to achieve that balance. So what we need here is to be very certain of earnings growth, right? Hence, we can invest in lower yielding companies, but enjoying that high growth as well. So we have to be very certain of this. And given that the average yield has come down for AI names, that balance is getting more difficult for us. And we're having to really have a very long, hard look at some of these companies in order to invest in them. But thankfully, like you mentioned, we are investing in opportunities in the small medium cap space as well, where yields are more palatable, right? So we have rotated some of the semiconductor positions into these types of names where they offer more value, right, for the same amount of growth. So I think thankfully we do uncover these opportunities. Hence, we still remain overweight semiconductors and AI, but we are very cognizant of the risks. But I think all in, we're still quite positive on this where valuations allow.
Thank you, Isaac. Well, yeah, I think that's kind of most of the questions answered, and yeah, all we've got time for now, I think. So thank you for those that submitted those questions, very insightful. And any who are still on the call that would like to explore the trust in a bit more detail, then it's just worth noting that Isaac and the team at Aberdeen publish a range of materials on their website, from trust-specific updates to also the broader market insights as well. So I'd certainly encourage you guys to go take a look at that. And before we wrap up, Isaac, just a really big thank you for going through that presentation. I think some really interesting insights and answers to the audience questions. It's been a pleasure having you on today's webinar.
Thanks, Joe. Been a pleasure.
So yeah, that does bring us to the end of today's session. We do hope that many of you will join us for the rest of the week's webinars. But with that, thank you for being with us today. Take care and goodbye for now.